Welcome to Futures Edge podcast. I'm Jim Urio, and with always behind the scenes and co-host Bob Iacchino, who's the brains behind the operation. And I'm lucky to have him even let me sit in front of the camera and talk, which is my favorite thing to do. But today we have one of our old buddies, one of our friends, Scott Shellady of RFD TV's The Cow Guy Close every day. At what time can they catch you on that, Scott?
1 Central, 2 Eastern.
1 Central, 2 Eastern every day. It's a fabulous show, particularly on Fridays. Particularly Fridays when the show starts at 1 o'clock. Whoever that guest is, man, that guy knows what he's talking about. Is all I'm telling you.
It doesn't matter if he knows what he's talking about. He's just downright good looking.
He's just downright good looking too. Whatever his name is, we'll figure that out later. We have a lot to talk about. These are interesting times we live in. Everything seemed to change. So my specialty is short-term rates, as you guys know. I've been trading and brokering those for forever. And over since that fateful Friday of the CPI 8.6, it has been an absolute cluster. Things have changed so rapidly from pricing in the Fed, 75 basis points, 75 basis points. What are they pricing out for the July meeting? 75 as well, right? That's what Fed Funds Futures are saying. Yeah. So let's talk about this. Let's talk about where the macroeconomic condition is. Was that CPI a reliable read? Are there things like, again, I'll get to the question real quick. You know, I like to hear myself talk. Are there things like liquidity being drawn out the market by asset price collapses already working to slow down the economy? What do you see?
I see two things. We have standard tightening, which is the Fed with their interest rate hikes. And we've got something I call synthetic tightening, which is everything else that's more expensive for you, right? And so we've got two things going on. Number one, a 0.75% hike in Wednesday with our rate here in the U.S. And we also have everything else you have to pull your wallet out getting more expensive by the day, whether it be food and fuel. I don't want to go down the litany of things. So here's my argument. I understand that the Fed's only got a couple of tools to fight inflation with, right? But I think that they're mostly backward looking. I think it's very difficult for the Fed to try to gauge what the economy is going to be doing in 3 months from now. And they have a hard time. They've always had a hard time judging that. And I think that this time around, for them to bust through that door, and I think they only came through that door because there was about 10 or 15 investment banks out of 30, by the way, that thought 0.75% would have been okay, that they thought this is our chance to look tough. Because they always talk a tough game, but they usually deliver dovishness, okay? And so I said in our meeting with Ashley that morning, she vouches, she's here. I think it's going to be a half. I'm 51.49, a half versus 0.75, but I can understand their reasoning. But their reasoning isn't an economic one. It's the market's giving us a chance to look big. And I felt like they came through that door, beat their chest. Look how tough we are. It's 0.75%. It's almost like that family at your barbecue on your Thursday afternoon club at your house, and they come over for a few cocktails, and you're wondering why that guy's being such a jerk to his kid. It's like he's disciplining his kid at the wrong time for the wrong reason, right? I felt that was Jay Powell. Yeah. And so I believe that in the last 8 weeks, the Atlanta Fed downgrading GDP growth is 0. Retail sales cratering, Philly Fed Index cratering, Michigan Sentiment Survey cratering. I feel as though that the sand underneath our feet is very, very shaky. I believe the economy is very, very shaky. There's a high likelihood by September our non-farm payroll number could be negative. And they wanted to come out of the box and be the Billy Big I Am right now and beat their chest because they did a 0.75% hike. I think we're going to see negative jobs growth in the next 4 months. And I think we probably end up cutting rates sometime next year.
So here, to underscore your point, the one thing that led me to believe for certain it was 75, they invoked the name of Paul Volcker twice within the last month. So for guys who've been around as long as the three of us have, we understand what that means. That's a subliminal message, like I am going to be the gallant and forceful and fierce inflation fighter. Yeah.
Paul Volcker is an 8% move.
Yeah. Yeah, but
not
that's
0.75. Not 0.75.
Yeah, no, it can't be 8% though.
Well, I understand that, so stop using Volcker.
Yeah, well, you're talking about them, not me, right?
I know, right? Yes.
Okay, good. But you understand what I'm saying? They use the name. That's part of the beating the chest, saying I'm a tough guy and I'm going to take care of this. But again, you mentioned one thing that Scott's alluding to is that high prices are a cure for high prices. People will start changing their behaviors and demand destruction, and we're beginning to see it. One thing you didn't mention, I want to ask you how much a big deal you think it is. Let's just go over the losses in asset prices. The crypto market itself went from 3 trillion to 900 billion. The stock market is probably lost. I don't know exactly what the dollar amount is.
Bobby, 11 trillion in equities.
Yeah, I was going to say 3 times that amount. Yeah, okay, good. So 11 trillion. So now we're talking about the NFT market, whatever the hell that is, or why we were talking about it when we were, because it was absolutely asinine. Ridiculous. You're going to buy imaginary shit? That's really what you're going to do with your money. So if ever you want to know, guys, people going forward, if you want to know where there's too much liquidity in the system, when people are fighting each other to buy imaginary shit. I heard some. Oh no, I can't even tell that story because Bobby, can I tell an off-curling story about the way somebody described NFTs to me? He goes, "It's like being married, and you have the marriage certificate to prove it, but everyone else can have sex with your wife." That's what he said about the NFT market. You're the one who owns it. You're the one who owns it. Okay. So anyway, let's get back to. But anyway, you haven't mentioned the thing that asset prices have just been cratering. That's a big part of it too, right?
That's what okay. Asset prices cratering. That's because the Feds are now raising rates at the same time. You have farmers, operational loans going through the roof because all these things are set to a level where they're all adjusting, right? Not that many people have arms in their homes, but operational loans for your business are all adjusting, right? So these guys, that's going to hurt them. All the people that believe that the Fed's going to get out of this quick form because they say they're going to get out of it quickly. Are putting all this money on credit cards, credit card usage through the roof, savings for the lower half. Now, saving rates for rich people is still fine. Lower half is plummeting. So, because everybody believes it's going to be a short-term thing. So here's my biggest argument of all time. You're going to put your faith in the people that got us into this to get us out of it. Shame on you, shame on us.
Yeah, amen to that. And now to underscore a couple of Scott's points too. First, look at the housing market. Just in the last probably 10 days, mortgage applications plummet. Number of houses inventory has gone up like between 10 and 12%. The number of houses that have lowered their prices has gone up. The numbers out of California that just came out today are even more stark than that. Inventory is having. So the worm has definitely turned there. Credit cards, you mentioned credit cards. We were at a very, very low rate of credit card defaults several weeks ago. That number has started to move higher. So to me, it seems like the recession is already here. The worm has turned, no?
Yeah, but I don't have enough of a following, and I'm not that big of a person in the business to say it's here, but I believe it's here. I think that with the Fed, look, we had an expectation of 1.1% growth in Q1. What did we miss that by? 2.5%? We came in with minus 1.4. What is that, 2.3%? So, we're now expecting 0. There's a high likelihood that could come in as a negative. And then here's the thing, Jimmy, I just had Dan Geltrude and Keith Fitzgerald on with myself, and I got mad about this, and I think that they did too. They were all frustrated. We have over 100 years of experience between the three of us. And we've never seen the Fed tighten into the teeth of a recession.
No, and it's happening. It's crazy.
Happening. And that's out of your mind, crazy stuff. So I don't know where to turn from here because I understand the rock and the hard place, but that rock just got bigger and the hard place just got harder. Yeah. But they put us into it. And so Here's the key. We have the key to the kingdom, ladies and gentlemen, the key to the kingdom. Unleash the Kraken, which is our oil. If we get our oil energy situation taken care of, that'll take care of 60 to 70% of our inflation problem. And I believe you don't even have to have the oil hit the map. They can just say they're going to do it. Open Keystone, build a refinery, do this, do that. They could jawbone crude oil down to $75 a barrel.
I agree completely. And Bobby, Bobby normally asks the questions. I was going to ask him to come in for questions after you mentioned oil, but I want him to answer a question first real quick, because I think that the Fed is absolutely needs to usher in a recession. That's what they thought too. But the only way that not needs to, they're going to do that is what I meant. They've decided to do that. The only way that recession can be shallow and short-lived is if we pivot 180 on crude. Bobby, do you agree? And what do you got to add to that?
First of all, I want to give a shout out to Ashley, the producer, who said something yesterday. Don't make a face. Don't make a face. Yesterday, she sent me an email saying Yeah, tell her to come on here because she sent me an email yesterday that said, hey, Scott wants to talk about XYZ on the show, right? I don't remember what it was, but she said, I've never seen Scott this mad except since yesterday. And you're actually getting that on display right now. Every 5 minutes, Scott's like, oh my God, these idiots, which I love. He used to be in the booth with us, like we'd be waiting to do TV spots and you'd be there, or I'd be there, Scott would be there. And every 5 minutes, Scott was like, Bob, no, you're wrong on that. And the screaming would start. And I'd be like, I'm going to go get coffee. Just take a minute, take a breath. Anyway,
really
Ashley,
right.
that was fantastic. I laughed for 15 minutes on that email. My question to Scott is this. You talk about the Fed wanting to be like, they wanted to come in and say they were a tough guy. I have a little bit of a different view on it. And I want you to tell me why I'm wrong, because I think I might be. I think it's like, I'm a big Marvel fan, and one of my favorite characters is the Hulk. Shocking, I'm Italian. They used to push him and push him and push him. And I remember him saying one time, Mr. McGee in that show, the Lou Ferrigno, I don't remember the other little guy show. He said, Mr. McGee, don't make me angry. You wouldn't like me when I'm angry. I imagine Jerome Powell going, seriously, you're pushing me into a corner here. Seriously. Okay, inflation's on me. You got it. Done. 75, 70, 50, 75, 75. Watch the recession come. You know, they put out the strategic economic projections, right? Which is the SEP, the Fed's projections of what they think is the most likely outcome. And I have them in front of me. I have them right here. And basically, they're looking at the next couple of years of 2% GDP, between 1.8 and 2.5% GDP, inflation at 2, and unemployment at 4.
All right, I'll have what they're smoking. That'd be great. Thank you.
Hello, Ashley.
Well, look, here's kind of the thing. What else are they supposed to do? Are they really supposed to go, okay, we're raising rates 75 basis points? I mean, I know this is what you want, Scotty, because you're all about just tell me the truth, I'll deal with it, right? As long as I've known you, that's how you've been. But are they really supposed to put out, so we're going to go 75, we just went 50, we're going to fight inflation, we think unemployment's going to be 10%, and we think GDP is going to be negative 1.6, and we think inflation is going to be 4. Are they really supposed to do that?
Okay, let me ask you this question then. Because I think transparency kills, like speed kills, okay? Why do we got to be so transparent? What's this whole thing about telling anybody anything? I mean, when you bought that Chicago t-shirt on the rack across the street of the Cubby Bear, right? And it said, this t-shirt is $8 here. Down the road, it's $9. Up the road, it's $6.50. That's transparency. Is that good for that t-shirt place? No, transparency kills. Why do they got to be so truthful? Why don't they just get up and say, we'll see you next month. We're data dependent. Have a nice night.
Amen.
Yeah, no, that's actually a remarkable point. That's a remarkable point.
No, Bobby, let me shoot in real quick. Not only transparency, because they're telling you what their thoughts are and where they project it, and they've proven to be bad at projecting things. They're not, and I'm not even one of these big Fed bashers all the time, but I'm saying they're below average at prognosticating, yet the market acts like, well, they said they're going to go 50 in 8 months. What the hell are we talking about? They have no idea if they're going 50 in 8 months. I agree with you 100% that the transparency thing ends up being a bad thing.
Okay, so here's a question, man.
You can't pivot.
Here's a question,
man. I just say one thing, and I know I was not invited to talk, but
are you kidding? Come on, it's Friday afternoon.
I'll say one thing and then I'll scoot back over to where the ice and beverages are. We were sitting here on, was it Wednesday
morning.
And I was like, it's going to be 75. He's like, no, it's 50. I was like, it's going to be 75. We never really talked about why either of us is feeling this way. It was just more of a bet, like, what's it going to be? But to highlight what you just said, Jim, about like the Fed bringing up in the last month twice, at least, invoking Volcker's name, I was like, all right, that's it. And listen, I'm a person who knows nothing. My part in this of us is I'm the TV person. I have the experience in TV that he has in the markets. I'm just here to make it look pretty and to present it in a clever kind of way and help him learn how to do that. So I'm still very new to the business world and this kind of news. But the reason, like the real true reason, is because they have screwed up and made the wrong decision every single step of the way. And to me, I was like, they're going to do 75 because it's the
It's the wrong thing to
Wrong
do.
thing to do.
It's
wrong thing to
Costanza.
do.
Right,
And that
Costanza.
is what, yes, it is. Whatever they should not be doing is what they end up doing.
That's
Just harken back to
fantastic.
every bad relationship any of us have ever had, and
Yeah.
that's really the kind of the same thing.
But I
Whatever
will
you're not
say, I want to
supposed
say
be doing,
something,
you're clearly doing.
right? Something kind of serious, because some people might watch and be saying that for a year, most of us, I assume you guys too, were screaming that the Fed should have been tightening 15 months ago. The Fed should have been stopping buying mortgage-backed bonds 15 years ago. And they're like, oh, then you can say that then they should have been tightening, but now they shouldn't be tightening. Absolutely, we can say that. Timing is everything in this game, and they blew the timing
Right.
part of it. They had a chance to get out, they didn't. Scott.
So we have other sources of information, which I'm sure you guys do. We get all that stuff across the decks, but I'm still reading information that says that the CPI is going to be closer to 9 for the next 2 to 4 months than it is to 8. And if that happens, he's going to tighten some more. And I'm telling you, they're going to ignore the fact that we are hurting at the ground level. Just like Granholm has no idea about energy, just like Biden has no idea about energy, just like a lot of other people in the cabinet have no idea about a lot of the things that they're supposed to do. I'm saying right now, they're going to overshoot it again, like they undershoot all the time, and we could be in big time trouble. That's my big worry. And so, when in our lifetime, guys, it's as stark to me as this, Jimmy. The government's going to let you open your business up to 25% capacity, just so you can go out of business slower. I mean, it's absolute ridiculousness. So is this
God.
Fed policy is ridiculousness, because the key to opening it up is our energy policy. That will take 60 to 70% of our price problems away, but we just won't do it. So we can't fight this unless we get the energy policy done. So if we can't fight it, then we're in for a really difficult time.
So I don't know. What we're talking about here is government and the things they've done over the last couple of years that have just been astounding in their hubris and astounding in how stupid they are. And I don't know if you guys saw the article and have been up to date on the Sri Lankan situation. So in April of 2001, the Sri Lankan government, in all their infinite wisdom, banned legally the import of synthetic fertilizer and said that every farmer had to use organic, domestically produced fertilizer. Since then, the prime minister, who's reversed the policy like 8 months later, said, yeah, I thought we had enough, but apparently I wasn't informed properly. And guess what? They've missed a whole season of growing. People are dying. Their number one export is tea. They didn't grow any tea. They're in such a messed up way. And it's all from what we're talking about here. These people come and they think they know better. They don't know better. Do you have any comments on that?
Well, of course I do, because we have, if we have a wet fall and these guys are pulling the stuff out of the ground, they dry it with propane. How much is that going to be?
Oh, God.
I mean, and so the risk that most farmers right now, I mean, I'm 25% in the ag world, right? We have a family farm. If they lose the prices at the board right now, the board prices we've got going on in Chicago, because they've already paid for their inputs, which have been through the roof up front. They need the outputs to be through the roof too. If they're not, they're in big, big trouble. And then we don't have people making food anymore. Now, I don't want to be too hyperbolic. We're going to somehow get something together here. But I'm telling you what, we have already tight stocks. We've got now a heat wave coming through the US, which is historic. We've got a historically dry Western US. We have food problems. We have fuel problems. There's a guy by the name of, he's a Greek guy on the East Coast who's a bigger oil refiner, billionaire himself, right? I can't remember his name off the top of my head, but he's so wealthy. He also owns a bunch of those small grocery stores that you see in New York, like just for people that.
I know the guy. I know the guy. He's a friend of Larry Kudlow's. He was the guy who ran for mayor and lost.
Yes. Yeah.
Can't remember his name either.
And he looked in the camera this weekend and said, somebody's trying to destroy our country from within. He's at the cutting edge of food and fuel. He's a refiner and he's got grocery stores. He says somebody's trying to destroy our country. I don't know where this comes from. I understand a lot of these things come from a noble idea in the first place. And I get Buttigieg, I get Granholm. I understand that everybody would like to be on wind and solar, but it's only 5% of what we do right now. It can't handle it.
It's digital currency.
Yeah, right. And then we're going, Ashley's yelling at me, and then now we have the digital currency problem. So we have so many energy issues that we're not confronting right now. It's all right to me right now about energy. If we can get that under control, and it's not hard. It's not hard. Go ahead, Jim.
So Bob, first to you and then to Scott. We talked about, they clearly have to pivot on energy policy and they have to do it in a grand way. Is that even possible, Bobby? Will that ever happen? No. And then Scott, you next.
It's not possible in this particular administration because the only chance they have of maintaining power, and I'm not coming from a political angle on this. We talked about this
not at all
before. Politicians' product is you, and it generates votes for them, which is their currency. So in order to generate votes, they have to continue to appeal to their base. So they can't pivot. The interesting thing, to stay on sort of your example about NFTs, Jimmy, the Biden administration is now going to oil producers and basically saying, look, I'm going to date you for a couple of years. I need you to build me a big house. You pay for it. And then I need you in 5-10 years, I need you to move out. I'm keeping the house. It's not, they're not going to go for it. They're just not. There's someone I might actually do that for. Whole nother conversation. So, but anyway, from a perspective of what they're trying to do with energy now to pressure the energy companies to do something that's not physically possible. When I started in the business, there were 279 refineries. There's 109 now. It takes about 10 years for a refinery to be profitable. So people talk about the production of crude oil. Okay, that's fine. Right now, the production of crude oil is not that far off of demand, not to the point where we'd have 116, 117.
Can I jump in real quick?
Yeah.
Did you see the numbers on Wednesday?
Yeah.
I made a guy on TV here say them twice. We're doing 12 million barrels a day. Last year was 11.2. Yeah. We're already overproducing last year.
Yeah.
So it's a refining issue is what Scott's saying. Yeah.
Well, yeah. I mean, the thing that I always look at when those numbers come out is I look at the refinery utilization numbers, first thing I search for. And it's literally at the top of the condensed PDF that the EIA puts out. 93.7% this past week. 94.2 before that. Just so you know, 95% is considered full capacity because through the 109 refineries that we have, there's always a piece of the refinery that needs repair, needs maintenance. It never gets to 100%. 95% is literally all out. And then where do they put it? So one of the things they can do is suspend the Jones Act, right? The Jones Act forbids refined product from being shipped out of non-US flagged vehicles, okay? Ships. So if they suspend the Jones Act, you could take some of that refined product, put it on Cypriot ships or German ships or something else and ship that stuff out so the refineries can now produce more product and get it out to other places. But they can't do it. And there's a shortage of those ships. Shipping costs are through the roof. When you talk about prices at the pump, it's not just crude oil.
Do you know where we're at? Refining? Do you know where we're refining right now? What percent of capacity we're refining at right now?
Yeah, I do. We're 93.7, which is basically 100%.
Right. So even if we could refine more, it's not going to. I mean, that 6 or 7% we're talking. That's not going to make a difference.
It doesn't make a difference.
Do you guys see the interview with Mike North of Chevron last week? His comments where he was talking about refining space and refineries, and he boldly said that there will never be another refinery built in this country at all. And his reasoning was that it's a 10-year timeline before you make money. The investors need 10 years out. And the energy policy bings around like a pinball around here. They have no idea what's going to be. Like Bobby said, in 5 years, you move out. And that's exactly what he said as well. And it was just so stark when he said it. Oh, yeah, there'll never be another refinery built. So again, it's surprise. The consequences of our actions are here. I mean, this is just the way it happens, right?
Can I go back to the brass tacks? So this is what I want to say, because I don't want to seem like a wimp here, because I understand that we only have interest rates and a Fed runoff that can help with that inflation problem, right? But here's where I'm coming from, guys. You know, you pull up and a woman in front of you at the gas, she can only put in $7 or $8, and that used to get her a couple, 3 gallons. It gets her 1.5 now. Okay, they're upset. People at Costco that can't pay their bills when they get up to the register because it's gone through the roof. I'm saying to you right now, I understand the Fed's ideas, but I don't think that they're really taking stock of the fact of how bad it is on the ground right now. And I think that I can kind of blame them, but I can't blame them because it's happened so quickly. In the last 8 months, it's got 8 weeks, not months, weeks, it's gotten that bad. And the reason why I say that is this. I don't believe the 11 million JOLTS jobs openings at all. Because let's just say they're true. And let's just say, I'm going to give you 2 hypotheticals. We do print a minus GDP the second quarter. How in the hell are we getting into a recession with a 3.6% unemployment rate and 11 million jobs open? It doesn't make sense to me. And I've been doing this job long enough. It doesn't make sense to me. Something's wrong.
So what are you
Okay,
suggesting about the
address
JOLTS? Are they double listing, triple listing jobs?
I don't know. I think it's got to do with gig workers. I think it's got to do with they're not taking into consideration what's going on. I think the employment landscape has changed way faster than the way that we measure it. Okay, and how in the heck are we having 11 million jobs open and we had a minus GDP in the first quarter? Just right there. How does that happen?
I got 3 things for you guys. And so Jimmy may or may not confirm the first thing I say. Number one, the JOLTS job is real in restaurants. All right. The restaurant, and my brother's has a restaurant. He cannot find workers. We come down here, we go to a place, we want to sit outside. They're like, we're not seating outside because we don't have enough employees. So at least in that sector, I don't know about the rest of it. That's number one. Number two, we won't get classified as a recession, even though we'll be in one. That's my theory.
I agree. I know it's Bob.
We all grew up, look, we all grew up with the technical definition of an inflation being 2 consecutive quarters of negative GDP growth.
Recession.
We just had one. The Atlanta Fed GDP estimate is at 0 right now.
Right.
So we could potentially have 2 in a row, but NABER, National Bureau of Economic Research, will say that employment, we're too close to full employment to classify this as a recession. So my prediction is we'll be in a recession, but they won't classify it as one.
But you have to be commonsensical, right? That's the great thing about growing up with a dad that had a farm. If it's raining, we don't go outside without an umbrella, right? It's that simple. So if you're going to tell me that we're in a recession, we have full employment, one of them's wrong. Either we're not in a recession or either we don't have full employment. That's simple, right? And if you can see what I see, and you can see the pain on the streets and people that don't have enough money to do the things they normally do, they're making decisions about whether they put gas in their tank or feed the kids. And by the way, you can't find any food for your kids, a whole other story. Then I think that maybe the Fed's JOLTS number is wrong, because I think that gig economy and the way that we measure that is just outdated. But it's pure speculation on my behalf.
I have some information. I did read an article. There's some data about ghost listing on JOLTS and what the motivation was behind it. I cannot quote it because I don't remember exactly what it was, but I will say that you're not alone in your theory that the JOLTS number may be overstating the amount of open jobs. Bobby, do you have any idea what I'm talking about or no?
Yeah, I've seen the same thing. There's a lot of data that's in question. There's a really, really smart guy. His last name is Weinstein. I don't remember his first name, but he works over at, what's that?
Brett,
Brett's
maybe?
brother. Brett's brother.
Oh, yeah, okay, yeah.
He works over with Peter Thiel at, what's his hedge fund?
No, something point.
I know of Peter. I don't know him personally.
I gotta find him. Here he is, Eric Weinstein. He's a managing director at Peter Thiel's hedge fund. I don't remember the name of the hedge fund right now, but Eric Weinstein has an entire paper that I can't understand because it's just simply too high level math for me, showing us how wrong CPI is. Okay, and how just the complete calculation of it is asinine.
Is it underestimated? It's underestimated.
Yep.
It's underestimated because of it's underestimated what he calls a pain threshold.
By a factor of what?
By about a factor of 2. So that was the conclusion. Now, the conclusion is a number should be listed as lower, but it should be taken more seriously. In other words, he says, like, people look at 2% CPI or PCE as being okay. He goes, it's actually double that and much worse than it is. So he says, you could list it at 2PI. It's way too complicated for me, but he basically says it's a joke. And we talk about JOLTS potentially being a joke. We talk about the employment number, that U6 might be a better estimate of how many people are actually unemployed because it doesn't take the participation rate into account. There's all these pieces of data. And I always sit there and think, I'm like, well, I mean, I got to make dinner with what I have, right? With the ingredients I have. So I got to try and figure out. This actually brings me to a question, Scott, because I agree with 99.8% of what you're saying, but it comes down to, with that kind of a prognosis and adding in Jimmy's, what I think is a fact, that there'll never be another refinery in this country. Would you ever advise someone, and you're not a financial planner, none of us are, to buy stocks ever again?
Yeah,
Talking
well,
to me?
I mean,
Both of
go
you.
ahead, Jimmy. Jimmy, you answer first. I'll tell you what my
Well,
answer is.
Okay. Yeah. I mean, again, I don't advise. I'll tell you what I do. And I'm still long. I mean, I'm not flat stocks. I'm looking for things to buy. I think that, now we're off 24% at our lows. I think that there's proper valuation. I do think there's going to be a pivot. I think that we're going to get back to more sensible economic policies in about 4 or 5 months, probably prior to the election, when people see the things that don't work. So I have to say that I'm still a bear of the stock market. I think down 30%. But you have to factor in the fact that 40% of the money supply has been tossed in over the last 2 years. That money, I mean, the whatever you're buying with that money has to stay high in price. And I'm not, and again, we talked about crude, and we talked about the Atlanta Fed sticky CPI, things that don't change price very much, being up 7%. But stocks and real estate are in that too. I think they're not going to go to zero in either of those. Just there's not these enormous market positions built up. So I have to disagree with you on that. Starting now, I don't hate the stock market. I think it's going down 30%, but I think if you've been on the sidelines a long time, I'm putting some more money to work. Am I an idiot, Scott?
No, I mean, it's down 23% as we speak, right? I mean, I didn't take a look at today's, so, and as my old man would say, what do you think it's going to do, go to zero? And by the way, if you want to bet on the sun exploding and you win the bet, what do you win, right? We're all bet anyway. So I agree with you there. My issue is this: I look at the stock market like it's an old, like why it was initially put there in the first place. Good companies that want to raise capital and do good things and produce good products. All too often, you get caught up in that hysteria of some new bell and whistle or something newer, and I think that's bad for the stock market. I really do, because that gets all the hype because it's got outsized returns. But I don't think the stock market is a bad thing at all for somebody that wants to invest. Look, if you would have bought the high every year since 1929, you'd be a billionaire.
Yeah. Bobby, you seem to have a different opinion.
No, I don't have a different opinion. I wrote a book that I never published. It's literally sitting right here. And the title of it was Rent the Bull Market, Don't Own It. And that's really what I believe.
Rent the bull market, don't own it. That's good.
Yep. And that's really what I believe, is that you should be buying stocks. I don't pick bottoms. I wait for the bottom to show itself. And then I try to catch a portion of it on the way back up. And then I get out. And then I buy something else and I try to catch that on the way up. Or in the case of futures, which we all trade, I'll short something and as it's on its way down. The real way to make money, in my opinion, is not buy low and sell high. It's buy high and sell higher.
100% true.
I think that's been proven.
That's very good advice.
So,
Yeah,
if you have the time and ability to look at these things and say, I want to get in here and get out there, it's an easier path. If you don't, you just got to buy it because of what Scott said.
Well, let me jump in real quick before we go. I totally agree with that estimation, what Jim or what Bob just said there. And that's how, I am now starting to finally get the calls from family and friends with their hair on fire. Oh my God, my life is over. And usually when that starts to happen, we start to carve out a low, okay? When people are starting to sell, get me out, I can't take it anymore. Because this is the time, you didn't want to sell 20% ago, now you want to sell down 40? I mean, what's your thought process there? Want to lock in that loss? I'm getting those calls. I'm getting people asking me for my advice. I have the licenses to manage their money. I just don't do it because I'm on TV and it's too dangerous of a playground for me. But I would say this, just by the calls and texts I'm getting, I'm feeling like we're getting closer.
All right. That's a good way to branch into our trading practice. So Scott, normally when we do this podcast, the macro guy stays on for about 20, 25 minutes. You've been here a half hour. Now we usually goodbye them. And then Bobby and I talk about trading, all the things we talk about. You, of course, are welcome to stay. It's totally up to you. Or if you want to go, just hit the goodbye button and be gone with it. What do you want?
You broke up. Say that again. You broke up.
Hang
So,
on.
normally
if you don't mind, I want to throw one question in for the two of you,
Sure.
and then we can either let Scott go or he can choose to stay and listen to our trades if he wants to.
I gotta go.
Okay. One last question then, and I want you both to tell me, I'm struggling with this. There's two things I struggle with, and I'm a capitalist. Why am I wrong in not liking that private equity is buying homes and then renting them out? And as a secondary question to that, why shouldn't a company be able to buy a life-saving drug and jack up the price if they want to?
Well, I'll answer it first, Scott, and then you go. So the buying the life-saving drug. Okay, we want people to make money because it brings more people in to the market to do things. But some of these markets are so heavily regulated and so heavily dominated by a few players that it makes it very difficult. So that's what makes that part confusing. The part about the housing, though, is they're getting rates to borrow at that nobody else can. In a normal world, and you and I talked about it with someone else in the show too, with Carol. And in a normal world, I would say, yeah, let the chips fall where they may. But I do agree that there should maybe be a roadblock put in to disrupt private investment interests for buying they're not a small amount, 20% of the homes over the last years, or 18%. I'm hyperbolic a little bit. But to me, yeah, I think it's a terrible thing. And they get to borrow at 0%, actually, whatever. It's a messed up situation. Scott?
All right. Well, when it comes to the housing, I've sat in at some of those meetings where we're buying tranches of real estate after the 2008 crash, right? I sat in it because I bought a place in 06 in Arizona. It doubled in value and then it went down by by 80%. I mean, it was just, I all of a sudden became an investment, went to a marriage. I was going to have it till I died, right? And I still have it. And it's now finally come back, and I'm afraid it's going to come off another 30% again.
I have one
which is
too.
fine. Huh?
I have one in Arizona too. Go ahead.
Yeah, which is fine. But it's disingenuous that they get to borrow at rates that regular people can't borrow at. That's not right. But if you don't like it, then we need to put something in there that makes it not possible, because they're just doing whatever is legally possible. And lo and behold, you have no idea of whether or not your money managers might have put money into a fund that invests in those guys, and that's how they get the capital to do what they're doing. I don't know, but I don't like it. It doesn't feel right. But that's just one of the uncomfortable consequences of capitalism. What was the first question again about stocks?
Well, it wasn't about stocks. It was basically about the same question with pharmaceuticals. If we're free market capitalists, which all three of us really are, these are two parts of the free market I don't like. Somebody goes out and buys a drug and jacks up the price. They should be able to.
I have an answer. Ashley's got an answer. What's your answer? And it's got to be within 5 seconds.
Okay. In a capitalistic society, yes, obviously, that is how you operate. But I also believe in compassionate conservatism. And when we are talking about a product, this is not rollerblades. This is not a cooler that's going to keep your ice frozen for 12 days. If we're talking about something that is saving somebody's life, listen, if we are ever going to have red tape and regulations, which we have far too many of, but if ever there was a time to have regulations, that's what it should be. If that's
fair.
Why.
I like it.
That's fair.
Okay, I'll say this. This is in a perfect world. I agree with that answer. It's a good answer. If you as a person come up with a life-saving drug that's not really, groundbreaking, cures cancer. I've always thought, and this is from when I was in high school, you should be rewarded.
100,000%.
Yeah.
You should be paid for that.
You should be rewarded for that. But I would reward that person like this. You and your corporation that you work for never have to pay taxes again.
I love it.
I mean, right? Something more personable than you're going to rip the ass out of the world for this drug, like the pharma guy did, Pharma Bro, right?
Yes.
I think that they should reward you with something that's like a golden ticket to Willy Wonka's chocolate factory, and you don't have to pay for the rest of your
R&D money. But we need R&D money to go toward pharma. I mean, so there has to be the promise of reward. Now that's an interesting reward.
But if you put money in, and you're part of that, your tax rate goes from 20 to 10.
I like it, Scott, for governor or mayor or
Let's
president,
be honest,
whatever the hell you want.
Pharma doesn't want any of these diseases to be cured.
Right, here we go.
Then they stop.
She's got the
making
light bulb
money.
theory. She thinks the people that make light bulbs don't want to make them not burn out, right? That's her theory.
Of course, planned obsolescence, it's called. It's been a theory forever. Yeah.
Right.
Okay, we got to get to the trades. I got to get the hell out of here at some point in time. It's Friday.
I do too.
I got a restaurant to run.
Scotty,
Okay,
thank
see
you.
ya.
Ashley, thank you.
See you guys. See you, Ashley. See you, Scott.
All right, take it easy, guys. Thank you. Have a good weekend.
So Bobby, the first thing I'm going to hit on is we talked about equities.
Yeah.
I'm still believe that we're in a bear market. I still believe that look at Scott still here.
I wanted to hear what you're saying about me. Bye.
Oh yeah, no, push it. I was going to say terrible things about you. So I believe
I don't know how
that
to
the bear
get out of
market.
this fucking thing.
I'm just kicking
Just
him
kill the
out.
whole screen.
I'm kicking him out.
You hit exit. Literally, you hit
No,
exit.
I
I
do.
know, I'm kidding.
This is our best podcast ever.
I kicked him out.
Okay, first trade, the stock market. Okay, we've several different times talked about bear market rallies happening. We're both still in the camp that we probably have more downside. I'm certainly firmly in that camp.
Yeah.
I like the way we closed on Friday. I like the way we rallied. What do you got to close at? We taped the show on Friday afternoon, people.
Yeah, I've
So,
got the
I
close
have it
at
36.81.
yeah, right about there.
36.81. So, okay, I'm long the SEP micros. I'm saying the long of 36.90. I got in a little better than that. I just thought that's where I may buy it again as it rallies to it, if it rallies to it on Sunday night or Monday. With the target of 37.90 on the upside, so 100 on the upside. One of the reasons we like micros, by the way, is you put on a couple of these and you can have a wider band of your trade. If you had on a full one on $50 a ticket at $50, granted you make 50 times $100, $5,000 on the upside, but also it can fly in your face if it's just a hunch trade. My stops placed at 36.39 on the downside, which would be two lows. I liked it because it defended its lows and bounced into the close on Friday. Do you think I'm an idiot?
No, I think you'll get your profit. I actually think it'll go higher than that. So one of the things I like is I like the way that we closed out today with that sort of long move toward positive from negative. So your target is just below the May 20th low, which is a good place to put it. But I actually think we'll get above 3,900 on this next move up. That's my belief. And I believe it's a bear market rally. I don't think it's some sort of crazy turnaround we should all be buying. But for this type of short-term trade, I like it a lot. I think once we get up above 9,800, I'll tell you exactly approximately where I think we're going to get to. I think we're going to get to about, let's call it 38.98. Okay. We get up there, we maybe spike above 3,900. And I think that's where I'm going to start to look for short trades again. This particular trade, look, everybody is saying, is this capitulation yet? Is this capitulation yet? Meaning they're looking for a place to buy. There's always going to be people that think they saw capitulation. And as long as there's people asking about capitulation, then we haven't seen it yet.
No. Where people just forget this whole thing and they're like, no, this is a stupid game.
I don't want to buy anything. I am out. Just get me out. That's capitulation. We haven't seen that yet. I think this trade will work.
So this in the micros, that's 100 ticks to the upside is $500 if you hit your target. If you're stopped out at your level at 36.39, that's losing $255 if you're stopped out there. What's your trade, Bobby?
So I am short silver. Okay.
No.
Yeah. Now, for me, this is very short term. Okay. For me on the silver trade, it's very short term. My target on this particular trade, well, first of all, I'm short at about 2160. So I'm a little underwater versus the settlement. Well, let me just double check the settlement on that, unless you have it in front of you. I got to close right on the close, 2160. So I'm short right on the close. My target on this one is only 2042. So it's only about $1.18 lower. And my stop is basically 2257. I like an extension of the down move, similar to the reason I like the up move on EES. Okay, I think we're going to get a little bit of a rally. We're going to get a little bit of weakness in precious metals. Now, overall, I think precious metals go a lot higher. I still have a long-term long in gold. I've had it since last July. Okay, and I think the recession play is actually going to help that trade. But in the short term, with yields falling lower, yields were up on the week, but they were lower on Friday at the close, right? I think this trade is likely to get me to my target. The technicals look good to match this up. But I am fading a double bottom. So if it goes and triggers a double bottom, that's basically right where my stop is, and I'm out.
So I ultimately, I don't dislike it. Here's what I would say, what would caution me is you saw after just yesterday on Thursday, Swiss National Bank raised rates. Bank of England talked about raising rates. I don't think they actually did anything. ECB, I'm not sure what they're doing. But anyway, that day then the dollar did crack a little bit. Then on Friday, it made some of it back up. But if those countries start to get serious about fighting inflation and defending their currency, our currency could crack, and silver and gold, I think, would rally. Yeah. I don't really see that happening in earnest. That would be just something I had on my radar. Because I have, other than that, I have zero problem with this. You know, I'm long silver and I'm long gold, and I hate myself for those trades because they've been painful. But I like them both
because, again, that's more of a marriage than an affair. Yeah. We got a theme in this podcast, totally.
No doubt about it.
That's more of a marriage than an affair. I'm married to gold as well. I'm doing something with silver on the side.
So let's talk really quickly last week's trade. And last week I put up two trades, the gold and the 10-year. 10-year's working just fine. It was working great. Now it's working good. The gold, lessons learned here. We had an outside dangle. This is last week's show. We had an outside day on Friday, and at 1880 was the high. And I had a brilliant stop-in trade at 1882, which 1882 and the half was the high on Sunday night, Monday morning, and then it absolutely cratered. So the lesson learned is this, is that, you know, technical analysis only goes so far. And sometimes you see those breakouts, and if it's a level that you're expecting an acceleration and a follow through, it might behoove you to put your stop in a lot tighter than where that 1845 was, which was $55 lower, because you know that level is of some importance. And actually, even looking at how it happened proves that level was some importance. They shot for it, and then they whipped it around and stuffed it. So next time, if I had to do that again and it was important breakout level, I would stop myself in just the same, but I'd have had my stop a lot tighter. Thoughts?
So one of the things people think about stops, especially retail traders, they'll be like, oh, they're hunting my stop. They're hunting my stop. I worked at a hedge fund. I worked at an institution. I worked at a prop shop as well as brokerage. I never remember anyone hunting stops. The reaction that people think they hunted my stop, the reason people get stopped out and then it goes the other way, is because a lot of people look at charts and a lot of people put their stops in the same areas. It's part of the reason that as things went more electronic and HFT took over, I started doing smaller and smaller position size and wider trades with longer duration, right? Simply because I didn't want to be involved in this, right? They don't hunt stops. What happens is as you get closer and closer to a key level, people just start panicking, pressing the sell button. They cancel their stop and get out to try and save themselves a little bit of money. So you either have to do what you just said, tighten the stop up and be right away or out, or they need to shrink the position size and stretch these things out a lot more. So I think you're right in saying that.
Okay, good. So let's get on to my last one is 10-year. And again, I had a 10-year trade from the last year too. I think rates are going higher, and I've been right. I was real right. Now I'm just kind of right. 327, the 10-year was the June micro. Think it's a
Yep.
buy at 327 with a target of 4 still on the upside. I'm keeping my same form. The reason I like this trade is because the stop seems pretty easy to me. I think 3% is a solid support level in 10-year. So I put the stop at 285. So that trade makes $730 if you hit your stop on the upside and loses 420 on the downside. Thoughts on that?
I love your stop. Let me tell you my 3 most important levels on the 10-year on yield. 313.5. Okay. 307 and 295. Those are my 3 critical levels, and your stop is below all 3 of them. That'd be like literally, I'm gonna use a superhero analogy again. You know, superhero runs through the first wall, then there's another wall, then there's another wall.
Excuse me.
It gets harder and harder to break through those walls, and stops work the same way. So you get through one support level, it gets harder and harder and harder to break through the next, and you're below 3 support levels the way that I look at markets. I also like the pattern. What happened with the 10-year yield is it broke out up. It went up to about 347, 348, came back down and tested its breakout area, and so far it's held. So if that holds, you'll get your profit on this one.
Good, I like it. Okay, I have messages for our potential sponsors. Don't watch this episode because it got a little rough in the beginning. This is a bad one for you to watch, okay? And I know we're talking to some people here, but go back to another one that's cleaner and thoughts.
Yeah, I do want to tell everybody we got some phenomenal shows coming up, not the least of which being a super show where we've got both Cameron Dawson and Amelia Bordeaux at the same time. That one is going to be spectacular simply because these are 2 of the smartest people out there in terms of like macro analysis. They both do some crazy work that, you know, if you're not reading it, reach out and I'll try and figure out a way for you to read it. The next show specifically as well, we just had Scott Shelley in this show. The next show, we've got Bill Baruch. We got Mike Arnold coming back, and we got Jim Bianco. We got Anne-Marie, I can't say her name right. Anne-Marie Bowden. It's Anne-Marie.
Yeah. I mean, I've been talking back and forth with her for years. I think she's brilliant, and I don't know how to pronounce her last name either.
Yeah.
Don't tell her that.
Find out before the show, but just so you guys know, we got some phenomenal shows coming up. So make sure you subscribe to this stuff. Follow me on Twitter. Follow Jimmy on Twitter. We'll keep retweeting it to keep you happy on it all.
Okay, and thanks for the support, you guys. You know, I like my thing is to hang up in the middle of discussion here. So
he still doesn't know how to do it. Cheers, everybody.